All right, so if you look at the stock market, the reason why it kind of continuously goes up. Now, I'm not talking just about individual stocks. Individual stocks can be obviously winners or losers depending on the industry, depending on the company and how it's ran. But the overall indices like the S&P 500 or the Dow or any of these broad-based um, aggregated indices that track like the S&P 500 is a good example. The reason why those always go up is because people are always chasing a return, and those are representative of the most productive companies out there. Sometimes they're trading companies in and out. And recently, like the S&P 500 is comprised of really like the top 10 or 20 names in the S&P 500 make up the most of the reason why it goes up. So it's weighted towards the most productive companies really suck up a lot of the reason why the index goes up, because they're growing, the stock price is going up tremendously, and they make up a larger percentage of the index. So the index goes up as a result, of like Nvidia or Apple or Google or Microsoft. Some of these bigger companies make up a big share of why these indices go up. But investors are always chasing yield. Younger investors are a little bit more risk on because they realize they have more time, and so they'll put their money into a little bit more risky things. And as opposed to someone who's older who might only buy, or they have a higher percentage of bonds or money market funds, guaranteed type things, maybe like 5%, 4%, 5% guaranteed. So they know they're not going to, have a year where they go down 20%. If you're younger, typically you're gonna be open to more risk because you want to have those years where you're making a very good return. If you're older, of course, you want to be a little bit more defensive just to protect what you already have, and you don't need to be making 20% a year. So that's traditionally why the indexes go up, because so many people are just chasing, they're dumping money every month or every 2 weeks whenever they get paid. Like a 401k plan is a good example. Every month or every 2 weeks when the employee gets paid, they're just automatically putting money into a mutual fund. And these mutual funds have different different allocations to certain indices and certain stocks, which just help continuously drive the price up. So that's kind of the reason, and the alternative, I guess, is you could say, well, I could just get a guaranteed return, like in a money market account or with a bond or a CD or something. But the trade-off there is that your return is usually really bad. It's usually below the real cost of inflation. And a lot of the stuff that I look at, inflation, like the real inflation rate is over 10% a year if you factor in cost of living, food, energy cost, housing, right? The bucket of everything that you have to pay for on a year over year basis is typically, or at least recently, it's 10%, if not more. So if you're getting a 5% return on a money market account, you're not doing good. Like, you're nominally making 5% more. So if you had 100,000 in there, then you get 105,000 back. But your 105,000 doesn't buy as much stuff because everything else in the real economy, the price of those goods went up. So your 105,000 just doesn't buy as much actual items, whether it's houses or shirts or if you need a haircut or Botox, whatever you're buying, right? The prices of those things go up. So that is why people, I think, are, especially younger people, they are more willing to be risky, because getting a 5% or even like a 7% return in today's economy doesn't really help you much. It's fine if over like a 30-year period, if you were to get a 7%, 8% return consistently over a 30-year period, you'd have a lot more money nominally. But the real question is, okay, at the end of 30 years, my money's been growing for 30 years with an average interest rate of like 7 or 8%. what can I really buy with that money? Maybe you have a couple $1,000,000. What can you really buy with a couple $1,000,000 in 30 years? You might not be able to really buy that much. It's like you thought you were getting a pretty good return, but the difference between getting 7% a year and getting 15% a year, or even getting like 13% a year, if you look at a compound calculator, is huge, right? So even getting 1% more over like a 30-year period, it results in a huge difference in the amount of money that you'll have at the end of like a 20-year or 30-year period, because all that money compounds over time. So that is why you want to be in things that are disruptive and that have the ability to really grow. Of course, there's more risk with it, but there's also a lot of risk of just doing the safe thing, because there's never, when you go the safe route, there's never really an opportunity for you to have like a huge year or a huge couple of years in terms of return. You might have a year where you do like 15%, 16%, maybe even close to 20%. But if you're in stuff that's disruptive and is, has the ability to outperform, you can have years where you're making 40%, 50% potentially on your money. And I think that's why younger people are drawn to that, because they know they have to get a good return in order to really maintain purchasing power or to grow their purchasing power. If you just get, like I was saying, if you just get 3, 4, 5, 6, 7%, even close to 10% on your money, if you don't have a huge principal, like a huge pot of money starting out, like I said, if you have $100,000 saved up, 10% return on that is only $10,000. Even if you had $500,000, a 10% return on that is $50,000. So that's pretty good, but $50,000, it's not like you could live on that for the rest of your life every year, right? If you had $5 million, you could see how it doesn't really matter. Like if you get 5% a year on $5 million, you're making $250,000 in income. But if you make 10% a year, you're making double that, right? So you want to be in things that are disruptive and that have the ability to outperform, especially over a longer period of time. If you're younger, it makes a huge difference, because like I said, getting maybe, let's say that you're doing pretty good and you're relatively diversified and you're getting like 16, 17% a year. If you're able to do that for 10 to 15 years, you're going to drastically outperform someone who is maybe in really, really safe stuff like mutual funds or company stock, and it's getting like 5, 6, 7% a year. Your money's just not really going to grow. And then at the end of it, when you pull the money out, what you're going to be able to buy with that money is going to be a lot less, because the real cost of living, inflation, has gone up at closer to 10%. So even though you have more money, nominally you have more money, you're not able to really buy things. Like just look at housing. Look what you can really afford with housing. Even if you had $2 million, if you live in a more expensive city, $2 million, you might be able to buy a house. But in some areas, that might not even be enough for a house, right? But it just depends. If you're younger, again, like I said, you want to be looking at things that are going to do good and have a little bit more risk. And even if you're a little bit older, you still want to have the ability to have a good year and not just be in things that are 100% guaranteed. Because if something's 100% guaranteed, it's not going to pay that well. Like a U.S. Treasury or a CD, right? They're not going to pay all that well, and you have to lock your money up for a fixed period of time. You can't use that money for anything else. It's all about opportunity cost. It's like I could put my money in this thing, but if I put my money here, then I can't put my money here, and you can only really put your resources in a you don't have an unlimited amount of money where you could just put it everywhere. You have to be willing to take calculated risks with what you do have in order to get a respectable return. So that's my thoughts. You guys can let me know what you think. You can subscribe if you want. See you on the next one. Take care.